What's up, guys? Welcome to a new episode of Founders Talk series where me, Dmitry Shvager, and my partner Kurt Heidolph talk about business, software, healthcare, and everything in between. And by the nature of our business, we talk to a lot of startups and we work with a lot of startups. And the topic about investments being raised on a regular basis. So in today's video, I wanted to talk about how to find the proper investment for your startup, especially when you're a first-time founder, because if you have 2 or 3 successful companies behind your back, you can raise money almost effortlessly. So Kurt, I really want to ask your opinion about this matter, because I remember we had this discussion previously, and you said that if you don't want to sell your soul at pre-seed stage, you need to fund everything yourself or with triple F investments.
Yes, that's very true, especially in the beginning like this. And I'll put this little tidbit out there. All of this that we're discussing today is kind of based on our own experience, and other people may have had other experience. So it's important to remember that all of this changes depending on what your background is and what you've been raising money for or looking to contribute money to, depending on which side of the funding you're sitting. But today we'll be talking mostly from our perspective of what we've experienced directly. So yes, when you first get started, it's often very difficult to find funding when you don't have a proven track record. And so that's where we get into self-funding, which we all know what that is. That's where we actually write those checks ourselves, or we find individuals who are willing to work with us for free or significantly reduced rates in order to keep our dream and project alive. The other big one is what we call the triple F funding, which is friends, family, and fools. That's often what's referred to as that initial stage money, because you're going to the people that you know best, who are willing to take a chance on you, or you come across that random person who just may not know better, the fool, and just gives you some type of capital. But often those people can, I'm not going to say often, sometimes those people can be the ones that actually strike it big because they took a risk very early on in something that had no real track record, and then it turned into something much larger than it was. So that's where we get those terms. And then, the real goal there is trying not to sell everything in the beginning, which is often difficult to do when you first start, because anyone who's taking a risk on you, they're going to want some type of reward. So the larger the risk, the larger the reward. And when you don't have that background of success, that means you're going to be giving up a little bit more in this process.
Yeah, that's correct. But I was also interested, at which stage it actually makes sense to look for investments. For example, we know these basic stages: pre-seed, seed, and Series A. And especially because we focus on working with digital health startups, sometimes at pre-seed stage, they just need money to buy the research or do the proof of concept without even having MVP. And then at seed stage, they're looking to raise some significant amount of money. So does it make sense to start at seed stage or just wait for Series A? Because the longer you fund the product or project with yourself or with your own money, the more equity you will eventually handle yourself.
That's true, but it's also about making sure that your project is successful. So one thing I like to say is that when you start something, make sure you have the resources to see it through to completion. I've been involved in projects myself, and I've worked with other projects where they've got a great idea, they start, but they don't have the funding necessary to really take it over the finish line. And so you get into this lurch behavior, this start, stop, and that can often be detrimental to the overall success of your product. So I usually say the best time to start looking for investment is now, or yesterday, or any time, because unless you're a fortunate individual who just has this wealth to be able to fund whatever project you want personally, you're going to need that investment at some point. Even if you're starting off really small, where it's you and a couple other people, you can only sustain that for so long. So you should always be thinking about, how can we make ourselves attractive to some type of investment, just to make sure that once we get started, we can continue and being productive and getting everything released that needs to be taken care of.
Okay, I see. So basically you need to start looking for investment options before you even start it, even if you don't need ones. But and this is actually makes sense because many people says that the most chased startups by VCs are those that don't actually need investment. So like that. And another point that I wanted to bring is that from theory point, every VC can fund you with money, and most people just chase VCs to find money, but there is so much value the VC can add additionally to the startup, and that could be the connections, the infrastructure, the knowledge, the board members. So I'm curious, from your perspective or from your experience, what would be the most beneficial additional value from VCs for healthcare and digital health startups?
Sure. Well, you're actually touching on 2 points, and it doesn't need to be necessarily, focused on digital healthcare startups, because this is really true for any startup that's looking for funding. So the 2 problems that you have is, 1, how do you find VCs? And 2, how do you find the right VC, or what is the right VC? And it doesn't necessarily have to be a VC. This, venture capital is a term that's used for, organizations who are kind of more structured towards investment. But, you can go to individual investors. There are also family offices that also do investment. Those are usually offices that are managing the wealth of another individual. So you've got a lot of different options to go to. But one of the hardest things that you have is actually finding these. How do you find these VCs? And, as they say in a lot of business, this is all about who you know. So getting out there, networking with other individuals, other professionals, other founders, and people who are starting businesses is a great way to find this investment capital, because it will come from places where you don't expect a lot of the time. So you really need to get out there, make introductions, and have other people make those introductions, because you can go online, you can look up a lot of this stuff, but ultimately it's going to come down to a lot of relationships. And that's where the second part of, what is a good investment partner or a good VC partner is, by looking at a lot of these, you're going to start to find out which ones are trending more toward what it is that you're offering. So if you're a tech startup, you obviously want to be involved with a investment partner who has some experience in tech, because it's not just money that they're bringing, they're also bringing experience. They're also bringing other introductions. So they may be the key to, yes, bringing you some investment capital, but they may also be like, hey, so you're looking to do this now, you're a team of 3 guys, but you really need more. And I've worked with this other software development company, for example, since that's a lot of what we do. You can go and work with these guys, and they'll be able to really take your vision to the next level. In fact, we've done a number of business partnerships that way, where we've been introduced to other founders or co-founders or startup individuals or people who have smaller teams. They're like, hey, this company's on the right track. Why don't you help them grow to that next stage? And with larger resources, there's more efficiency. And this is where those introductions can be so valuable, because they put you in touch with the right people. And the same thing too, once they've come to you, once they've put some time and energy into you, and not even necessarily investment, they may say, hey, so I can't invest in you right now, but I work with this other group that can, and they can help open that door for you. Whereas normally it may be very difficult to get in that door. So I usually say, first start looking, try and find out all the different options that are available in your area, within your network, as far as investment partners may be. And then from there, narrow it down to ones that can actually help you, because you want someone who can help take your idea to the next level, and someone who's not just looking to put money in and then leave you hanging there with all of a sudden some type of large debt over your company or things like that.
So basically, just like you have ideal customer profile in your business, you should have ideal VC profile. And I would suggest that, unlike business when you go with the wrong customer, going with the wrong VC can damage your company in a much more bigger way because of the impact that we see actually imply to your company, right?
Exactly. Because, here you're talking about, there are different types of investments. And, depending on what we're talking about, you can talk about debt investments, equity investments, convertible debt that, they have the option to convert it to equity later. And all of these have different implications on the future structure of your company and your future ability to grow and to raise money, because most of the time that first investment that you get, or the first few investments, aren't going to be your last. So you really have to consider where all of this is leading down the road so you can be prepared and set up for success.
Basically mentioned a few of typical investments or deals that you can get from VC. So can we have a complete list or more full list of the actual deals that you can get based on the VCs, and what would be the most preferable deals for the startup founders?
Sure. Well, the most preferable deals are usually direct equity because they're pretty straightforward. Someone comes in, they're offering you some type of monetary compensation, and you're giving them some type of ownership in your company. That's kind of a deeper discussion, based on the valuation, which we can dive into that a little bit more here later. But that's the basic concept there, and that's usually the best because there's the least amount of risk involved with that. Sometimes when they're doing equity investment, they may want some additional securities. So that could be things like warrants, for example. They may be given, they may buy equity, and they may buy warrants along with that, so that in the future, they have the option to get further investment in your company at their current rate or whatever the negotiated warrant rate may be. So that's ideal. What's more common, though, is usually some type of debt investment. So that comes down to two options most often. One is just straight debt. That's someone gives you $100,000 at a specific interest rate with a specific payback term, and that's it. Just like getting a business loan from a bank. There's not too much different there other than you're hoping for either more favorable rates, or it's maybe because you can't get a direct business loan, or maybe this individual, is one of those people who can open up other doors for you. So the other one that's related to that is convertible debt. So that's where someone, just like that second example there, they invest in your company, $100,000 at set interest rates and everything else, but they have the option to convert that debt and its, accrued interest and anything else related to it into equity at a predetermined valuation. So let's say it's day one of your company, someone gives you $10,000 and your company's only worth $100,000 because there's just nothing there. So they've invested, basically 10% of the company's equity as debt, and they may be like, hey, I want the option to be able to convert this in the future at that rate, at that same valuation. So, a few years go by, company's now worth, let's say $10 million. So now that $10,000 investment, they can technically, if they negotiated that way, they could convert that $10,000 investment into, what could theoretically be a 10% equity ownership in your 10 million, which would be $1 million. So, hey, that's a great deal for them. Not saying that that's how all these work out, but that's kind of the idea that you need to keep in mind, that, whatever they're converting at or whatever they've negotiated for that conversion, that's something that can grow and change with your company. So there are lots of ways to structure those deals. That's kind of like the real basic way to look at it, but there are oftentimes warrants thrown in with those options. There are the ability to convert at different rates at different times. I mean, these contracts can get very complicated as you dig into them further. But it's good reading and good experience to learn how these operate and then figure out how that person, again, is going to help contribute to the growth of your company.
Okay, so to summarize, you need to start looking for investments as soon as possible. You need to identify ideal VC profile to understand what outcome you can get besides the money. The best VC deals comes from your networking, and the best deals would be the deal based on equity. So guys, I really hope you enjoyed today's video, so please support the channel with like and subscription, and let us know in the comments below what else you would like us to highlight. See you!